We'd now like to move on with our next panel discussion, which is on microcredit and microfinance. Of course, we'll be discussing the pioneering inventive financial inclusions in today's contemporary market setting, along with transforming various aspects of microfinance and aiding financial literacy and more. May I now present to you our panel chair for the session, Mr. Alok Prasad, Chief Executive Officer, Microfinance Institution Network. Let's put our hands together as he joins us on stage. We'd also like to welcome the panelists, Mr. Gagan Banga, Vice Chairman and Managing Director, Indiabulls Housing Finance. We just had tea. I'm sure we're more fresh than this. Let's put our hands together as I also welcome on stage Mr. S. Vishwanathan, former Managing Director, State Bank of India. Mr. Abhijit Ray, Co-Founder and Managing Director, Unitas Capital. Mr. Sunil Sinha, Director, Public Finance, India Rating and Research. Gentlemen, I'd like to welcome each one of you. As we mic them up, I'd like to once again mention that post the panel discussion, we'll be more than happy to open it for an interactive session, and of course our moderator will be taking things forward. Mr. Prasad, taking things forward.
Yeah.
Sir.
Very good afternoon, everybody. I guess we've all been wired up and ready to face the audience and the world. We've had some extremely interesting and insightful conversations earlier in the day, and which I think has pretty much set the tone for this panel's discussions. For starters, let me do a quick round of introductions while you have the booklets and therefore probably familiar with the panelists, but nonetheless. On my left we have Mr. Vishwanathan, who is a very seasoned banker. He was till very recently the Managing Director of the State Bank of India. Very warm welcome. And I must make a mention that till yesterday morning, he didn't know he was supposed to be here. Oh, evening actually, yeah. And then, of course, some frantic calls, and he very kindly consented to join us. On my right is Gagan Banga, who is the Vice Chair of Indiabulls, again, almost a household name now. Then, of course, we have Mr. Sinha, who is an economist. And of course, finally, Abhijit, an investor and also a banker before that. We pretty much have, I guess, the entire universe of stakeholders and players in the financial inclusion space covered by this. We have the banker, we have the NBFC, we have the economist, and we have the investor. By way of a quick sort of setting the tone of this conversation, and the idea really is to keep this very conversational. I don't know how many of you are aware that the term financial inclusion, which is bandied around so much, was actually used for the first time as recently as 2006 in a public document. Dr. Rangarajan's report for the first time used that term. I'm not too sure who coined it, of course, but yes, public usage, Dr. Rangaraj in 2006. However, the fact of the matter is that as a plank of public policy, financial inclusion has been a part of us almost forever. Going back to the 1950s when the Imperial Bank of India got nationalized and became the State Bank of India, which of course Vishwanathan can say much more about. And the push given by the central government and the Reserve Bank of India for moving banks into the rural markets. So it began as far back as the 50s, and a bunch of things happened after that. Some highlights: 69, first phase of bank nationalization, 14 banks nationalized. Thereafter the RRBs and the LABs, second phase of nationalization, BCs, so on. A whole bunch of things. Having said that, the unhappy reality is that despite all the policy initiatives and interventions dating back to the 50s, we have extremely large segments of our population who are financially excluded. The numbers we can keep talking about, and depending on which report you're reading, you will find the numbers will vary a bit as a matter of detail. However, what does not vary is the fact that the numbers are very large, and in any event, I think it can be safely contended that more than half our population is, for the most part, financially excluded. Now, there are three key themes we shall be talking about in today's in this panel, and the first is really about reinventing financial inclusion. And really, as we are seeing today, the fact of the matter is that there is almost a tectonic shift which is taking place in the way we are now seeing financial inclusion. And everybody has talked about this today. We've had the Jan Dhan Yojana announced by the Prime Minister on the 15th of August. It is getting formally launched day after here in Delhi. I think a lot of people in the room are going to be invited for that program. And it does represent in many different kinds of ways almost like a leap forward for promoting financial inclusion. And there is this big hairy target put out for bankers. Not going to be happening very easily. 115 million accounts, in a space of what, about 2 years only. I do recall a conversation with Nachiket when his report came out, when he talked of, again, some very, very ambitious targets going up to 2016-17. And I said, will this happen? Now what we're seeing is something else. We're having the Prime Minister saying even more ambitious targets in a shorter time frame, which is really what the story is when we talk about how do we, in a manner of speaking, reinvent financial inclusion. We have globally very interesting models. Mr. Sharma Aruna mentioned a short while ago about M-Pesa, which they're trying out in Madhya Pradesh. In any case, MP has been a pioneer and has done some extremely good work. We heard about that. Now the question truly is, what is it that we can do today looking ahead to make this happen? And somebody talked about disruptive innovations, maybe even that. And the question really is, how do we make it happen? The Kenya model, M-Pesa, and of course, equally more recently, M-Shwari, have been very interesting. M-Shwari, just to quickly make a mention, they managed to open something like 3 million bank accounts in a space of 5 months, and did this on a commercially sustainable basis. Now with that, let me now move on to my panelists, and let me first of all have Mr. Vishwanathan from the State Bank talk about how does he react to this whole story of reinventing financial inclusion, of being able to deliver on these large, ambitious goals which we have, because ultimately the story is scale. Our problems are very, very large. Until we can get the scale, it's not happening. So,
thank you. You know, like was said, financial inclusion has been with us since 1955, so to say, when State Bank came in. It was not financial inclusion at that time. It was taking banking to the rural areas, taking banking to various points closer to the user. It was not from a user's perspective in the sense the user somehow or the other is connected into the bank, but then bank attempts to place itself among people so that people can connect into the bank. Now that was the first understanding of financial inclusion, and in that inclusion was loaning, was deposit taking, etc. And it is in that context that State Bank has opened branches, public sector banks came in, they've opened equal number of branches, now even private sector banks are going inside and opening brick and mortar branches, big branches. Anytime there was anything, they'd say immediately that district is not covered, so you need to open a branch, and the branch would be opened. Now that was step number one. The branches were not connected. There's no way in which one person in one branch could go to another branch. That was one. Those were all negative points. But at the same time, the bank attempted to go closer. Banks attempted to go closer to the customer. That was first understanding of financial inclusion. Then came focus on the customer, that was reasoned, that so many people are connected into the banking system, so many are not. Only about 56-57% they have bank accounts. They have bank accounts. They may be dormant accounts, they may be some other accounts, they may be useless accounts, they may not be using those accounts, but they have bank accounts. So I really don't even know whether 55% of the people have bank accounts, but I think they must have counted it by saying that 55%, I mean there is an X number of bank accounts divided by the population, that is 55%. So, maybe even lesser than 55 might be having bank accounts. So now the attempt is to take people into bank accounts. Do they understand bank accounts? Do they know what a bank account means? Do they know why they should open bank accounts? What are the advantages? Then are the bank accounts providing all the services that are required by the client? For example, remittance services, deposit services, deposit taking services, then lending services, loaning services. Then are they providing now new things which people are talking about and which we are now capable of providing, insurance services, be it accidental death insurance, accident insurance or life insurance, etc. Then now the new thing which is coming is pension services. Can we provide pension services to people in various places? I can tell you, I worked in a particular position in State Bank where all the subsidiaries of State Bank used to report to me, and we were building products to take through the bank into various segments. This Jan Dhan Yojana which is talking about, if you don't mind, the Jan Dhan Yojana which is talking about insurance, accidental death insurance. SBI is already there in this, and many other banks are. And we used to provide for 100 rupees, 4 lakh rupee accidental death insurance. Accidental death insurance, not just accident insurance, because it's very difficult to figure out what accident took place where and who got hurt, and there'll be problems about this thing. That was why it's an unfortunate thing, but we said there must be some reference point which is easier to measure. So we had that. Now we found that for 1 lakh, 100 rupees, 4 lakh was too, it was just not working out. Then we made it 2 lakhs now. But it's still selling like hotcakes. Now, we possibly have 1 lakh rupee now for 50 rupees. And I really don't know whether the Jan Dhan Yojana debit card is going to be free or are they going to charge 50 rupees or I don't know. I'm not aware of that. Okay, but the 50 rupees somebody will have to pay. 50 or 100 or maybe it's less now. I don't know. Maybe there's because of competition, because of a larger number of people coming, the 100 will become 80 or 70 maybe over a period of time. And I think postal life insurance is also quite inexpensive, maybe they can come in. So effectively, now the understanding of financial inclusion is getting expanded more and more into newer products, newer way of. Secondly, the banks earlier were simply opening branches because the government was asking us to open. We were not bothered whether we were making profit or loss, and it was a developmental kind of a, mindset. We had to open, we opened and we made money elsewhere and, transferred that money into this. But as we go forward, and as newer and newer players come in, this is not going to work. That, you open it, and particularly with all these segmented banks which are coming up now. One set of segmented bank is simply to take deposit and put that money in G-Secs. Now, that segment, I really don't know, whether they can afford to open bank branches all over the place just like that, unless they make money. So the whole paradigm of financial inclusion not only is, covering the products, the range of products, it is also going to cover the way we cover these products, and make them cost effective at every point. In order to do that, quick this thing before we go into we'll talk about it more a little later. I was very impressed with the Additional Chief Secretary talking about that. That was something which, when I was CGM in Northeast, I used to push, saying that, and as a matter of fact, I gave a hearing to RBI's committee. I gave them a big, feedback, and then they made all these Kirana stores BCs. Till then, Kirana stores were not allowed to be BCs, till about 3 years ago. They made them BCs. Ultimate success of this financial inclusion is going to be delivery cheap. Delivery cheap with people who have cash with them. Moving of cash is a huge cost. People now move cash without insurance. They move cash sitting on scooter. They're all dangerous stuff. And now with the banks being told, you will bear the cost of, even the cash which is lying with the BCs. The interest will be borne by the bank. See, all these costs, people who are not in the main thing of the newspapers don't understand this. But every little thing costs money, and when we're going to do it as a business, we need to rope in every possible entity in the system, collaborate with them, synergize with their working and, use every little touch point that you can get in order to disburse money and take back cash from them. Petrol stations are another big, thing which we've been talking to, as a part of the supply chain management, whether they can pay cash to all these RuPay people in some form or the other. So we will talk more about that as we go forward. The whole complexion of financial inclusion in terms of products, in terms of the delivery, in terms of the way of delivering, in terms of the need for greater efficiency is changing the whole landscape as we move forward. And there's going to be no end to this changes. It is going to go on, and as we learn more and more as we go forward. These Kenya models and the Nigerian models need not necessarily work in India, and we have to ultimately learn from them and evolve our own solutions. Banks are still not irrelevant. The other party's relevance is increasing, and the competition between the two on a level playing field will be very, very essential. It is not as if one guy can be allowed to lend at 25%, another guy will be forced to lend at 10%. And that way, you're not going to have a level playing field, and whatever little development can take place from the larger players like the banks will stop if these things are not leveled out. More later. Thank you.
Thank you very much. We heard a banker's perspective, and I have here Gagan as a non-banker, NBFC. And I would imagine that there's a lot which actually the NBFCs, the non-banks, have got to be doing. Of course, more particularly, the NBFC MFIs for that matter, something which Mr. Sharma also alluded to a short while ago. Might even share with everybody here in the room that in a meeting with the Secretary of Financial Services just last week, as an industry, the NBFC MFIs, MPIN, we committed to the government that this industry will support the opening of 30 million accounts. In effect, every single client of the NBFC MFIs, 30 million and counting, will have an account opened. So really, in terms of being able to work together with the banks, because that is the only good model, it's all about being able to forge constructive partnerships, and that is the only way good things happen. So, Gagan, over to you as a non-bank.
Yeah, besides the microfinance, I think one very interesting area in which housing finance companies, which are a subcategory of NBFCs, are contributing is in the fact that as India prepares to become the most populous country by 2025, what is projected is that we would have a housing shortfall of about 7.2 crore units. And housing finance companies are working towards providing last mile credit, are also leveraging on various schemes provided by our regulator, which is the National Housing Bank, in ensuring that the poor people who need to own homes which are priced at under 5 lakhs, under 10 lakhs, under 25 lakhs, there is an appropriate mechanism of delivering credit to these people. There are several government schemes. There are several schemes run jointly by the RBI as well as NHB. Loans below 25 lakhs are already categorized as priority sector loans for banks. I think what is in due course of time going to really facilitate the government target of housing for all, as well as this issue of ensuring that the 7.2 crore unit shortfall is actually reduced. I believe there have been several meetings in Delhi in which there are targets which have been set of up to 4 crore units being made by 2022 and covering the shortfall of tier 1, 2, 3 and 4 type of cities. So in the backdrop of this, I believe that housing finance companies would really leverage their relationship at one end with the bank, which has to start seeing HFCs as a conduit of credit, and at the other end in leveraging their super specialization in understanding people who are not necessarily salaried. So while it is very correct that there has to be delivery of credit through business correspondents like the Kirana shop owner, There is also a perspective where the kirana shop owner needs to own a house, but his income is not understood, and I think institutions like ours would be going a long way in leveraging that understanding. The other place where NBFCs and some select housing finance companies would be contributing, are currently already contributing at scale, is using the house as a collateral and giving a lot of credit to the MSME segment. I believe the MSME segment continues to be one which it is largely devoid of credit. If credit is available, it is either available in a very unstructured format. Banks attempt to flow credit to it, but they have to take their own time and understanding. And the understanding of a relatively small housing finance company which is focused on providing credit around assets being mortgaged and around understanding cash flows of small businesses. There is a very substantial credit flow which has happened. In the 10 years that we've been doing this business, I have seen the market expand from something like 2,000 to 2,500 crores in 2004 to almost 12,000 crores today. That's the type of expansion which has happened, and that's the type of flow which is happening through housing finance companies and NBFCs to the MSME segment. So I'm sure if the model adopted by the regulatory agencies as well as the government is one of collaboration, where banks and housing finance companies collaborate and NBFCs collaborate to provide credit to wherever there is specialization required. Much like MFIs collaborate today with banks to give credit to people whose appraisal is extremely difficult to do. I believe that the government's agenda of housing for all, home for all would actually become a reality.
Thank you, Gagan. Let me move on to my friend Abhijit. He's been a banker, but been more recently an investor in social businesses and microfinance, of course. From an investor's perspective, where do you see things moving? Do you see the industry really at an inflection point? Do you see some dramatic changes happening as we look ahead?
Thanks, Alok. Thanks, organizers, to give me an opportunity to come here. And Alok has put it for me to use the lens of an investor. Just I'll clarify a bit, right? We are an investment banker, so we do carry the investor perspective, so I can share that. But before going into specifically from an investor perspective, some of the things I want to add on to what Sir said or my fellow panelists said is, if you look at the entire spectrum, India is a large country. We have seen multiple models emerge over a period of time, and every model has a learning. So it's not just about a card. It's just not about cash built into a card. It is not about just an account. But a lot of experiments happened and happened successfully across the length and breadth of the country. You all know there were local area banks, labs. A lot of licenses were given. But some of them are working really well, whether it is in Punjab, whether it is in Andhra Pradesh. I think 3-4 are working really well. Look at RRB space. There also a lot of technology intervention happened. Some of them are amazingly good example of financial inclusion. Look at the 3-tier cooperative structure. Madam was talking of PACS. And I have seen the level of data which a PACS has kept in the past in terms of once they computerize and then the 3-tier structure. The financial inclusion has gone really deep there. So if I take all this, so one side the banking sector with lab, the RRBs, the nationalized banks, one side where they have done financial inclusion. The other side, if I look at the SHG program, the microfinance program, wherein we are seeing that technological intervention has come in. For some MFIs, it has come in at a very early stage, some came in pretty late. But scale can only be achieved with tremendous amount of depth in technology. And today, whenever we are talking of cash and in a wallet, which is a card wallet, it has to be a very technology-driven initiative. So from a banking perspective, from a MFI perspective, from a SHG perspective, we have seen a lot of changes. Even we have seen organizations, not only in NBFC, MFI, but if you look at organizations like KGFS, the Kshetriya Rural Gramin Services, wherein they have come up with a service of what you can call as a 360-degree service for the clients, the wealth management service and others. And then if we move further down from a pure play, straight, regimental microfinance model, move to technology-driven, and then now if you look at what else, like as my fellow panelist was talking about MSME sector, we have seen tremendous level of innovations. Like from microfinance, we came to livelihood finance, LFI. Livelihood finance, Vistar started. What is it? The next level of microfinance. Probably moving from up to 30, above 30 or 50 to a 2 crore level. And then the innovation happened. There are a lot of new players are coming in. So whether it is, organization like Vistar, which today commands huge respect in the market, both from investor and regulator perspective, huge challenges initially because banks were not ready to fund. Then if you look at next level, organizations like, Capital Float, Neo Growth. What are innovations happening in this sector? Capital Float says 7 days you can get a loan. Obviously, it's sort of a bit, I would say a bit upper end of the spectrum in MSME, probably, 10, 15 lakhs to 25, 30 lakhs. And then you look at Neo Growth. They are talking of all these Kirana shops. Most of them don't have bank account, or if they have bank account, don't get a credit for different reasons. Neo Growth, I had an interaction, I learned that 70% of the customers don't have, a loan. And that's where Neo Growth comes in, just a platform wherein they are trying to see how to see the future receivables and build an EMI onto that. And there's a very interesting organization, very small today, I think one should look at it. It's called Kinara Capital. Can you think of receivable finance in 1 or 2 or 3 lakh? It's a bill discounting. And NBFC doing bill discounting of 1, 2, 3 lakh limit. Isn't it innovative? Yes. So my take in all this is tremendous level of effort has happened. A lot of MFIs tried with Visa, MasterCard, now RuPay. A lot of new platforms are coming in. And the NBFCs, the other banks and all did a tremendous amount of work. How we can see the learnings, and now the new banking license coming up, the small bank, and see that we can really effectively do it, because so many learnings are there, and I don't know how much of learning is ultimately going into building the new models. So I know in a country like India, you need multiple approaches, but I think we should try to really see where we can take the advantages of those learnings and move to the next level. Coming to the investor perspective, as Alok has asked me to highlight, investors always look at differentiator. What is the differentiation between two models? Somebody who's trying to do something new, somebody who's trying to capture the market in a different way. Even today, microfinance, after all these years, I think today tremendous level of interest we saw in the last 4 or 5 years. But after that, now also people are asking if there's an innovative model, we'll try it out. Investor looking at it. It's not a traditional model getting funding, but the level of interest is more on the, new product development, innovative approaches, technology-based interventions, or a different model like what we started, what, Capital Float is doing, what Neo Growth is doing, what Kinara Capital is doing, probably what Electronica is doing. So different approaches are coming in, and investors' perspective is the country is large, market is never a problem. In India, if you have a good product, efficiently done, and priced well. Pricing is very important. So how can you get into a efficient pricing is when you have a very solid platform when you can get the economies of scale. So investors looking at differentiated model, scale is not an issue, solid management team, and anything where you can leverage the existing network to grow your business very fast.
Thanks, Abhijit. Dr. Sinha, as an economist, typically you look at trends and patterns and how are things actually moving at a kind of a macro picture. So looking at financial inclusion, we've seen the past, and now we are, as I said, at an inflection point. Based on the way things have happened and the way currently we are poised, your comments?
Well, as the issue has been highlighted both in this session as well as in the earlier session, that in the last couple of years, financial inclusion has really been talked about a lot, and more emphasis is being given. In my view, somewhere it all started immediately after independence, but obviously it has moved through different phases, and in different phases we have talked about different things. We may not have called them financial inclusion or inclusive growth, but in my view, all of these have been the undercurrent or underlying theme of our developmental process all along. However, in the last 1 decade or so, the term financial inclusion or inclusive growth became quite important simply because the country witnessed much faster growth, which it has not seen in the last, maybe in the first 50 years or so. But at the same time, it also witnessed that the fruits of this growth has remained confined to a certain section of the people. It has not reached, or it is not reaching to a large section of the people who should have benefited from this growth. So the whole approach was that how can you also devise models, both developmental as well as in other areas, so that these people could also get a chance to share the benefit of the growth that the country is witnessing. In my view, what is different at this point of time is that there is a much more granular approach to reach out to those people who somehow or the other have not benefited or have not got included into the mainstream. So whether we look at it from the perspective of the government, whether we look at it from the perspective of the bankers, whether we look at it from the perspective of even companies who are into the business, say for example the FMCG companies. Now for them, the growth engines are no longer the urban areas. The growth engines are the rural areas. So when we talk of financial inclusion, or when I talk of inclusive growth, then inclusive growth doesn't mean only that you give them a bank account or some financial product, but how do you improve their livelihood conditions? Now there the role of even the FMCG companies are as important maybe as the role of a banking sector. So from this perspective, obviously things have moved, but the way I look at it, and as rightly pointed out, that India is such a vast country that multiple approaches have been tried, but at the same time, whenever we come to planning a thing, we still have what is called command and control approach. That we try to think big and believe that one size fits all will somewhere work in this country and will ultimately bring about the change that we all are looking for. However, the ground level realities and the micro experiences give you the other perspective. Somewhere, I mean, in this whole process, I think there has to be a mixture of both. And how to bring about that mixture, in my view, continues to be a challenge and will remain a challenge. Because when I look at various experiments across the country, whether it is in microfinance or for that matter, even in the case of cooperatives, you will see that the cooperative structure has worked exceedingly well in certain parts of the country, but the same structure has absolutely or miserably failed in the other parts of the country. Now, if there is no inherent problem with the structure as such, then why it succeeds in one area, why it doesn't succeed in area? I think there is a cultural dimension to that. And in most of our approaches, somewhere the micro experiments do capture that, but the macro perspectives fails to capture that. So this is, in my view, is going to be the biggest challenge for the policy makers, that how do you capture the micro experience and mesh with the macro experience, and then create a model which is scalable but differentiated in its approach depending upon the realities of that particular area or space.
Thank you, Dr. Sinha, and I think that the point you made about command and control and the need for ensuring differentiation on the ground in a country as diverse as ours are absolutely critical. Let's move on to a slightly different segment now. Microfinance, microcredit have been traditionally been seen, by traditionally, even by regulation, as loans up to a certain size, rupees 50,000 to be specific. However, there is a large universe out there which equally is financially excluded, broadly or loosely the MSME category, where I am a small entrepreneur, I needed a loan of rupees 5 lakhs or 7 lakhs or 10 lakhs. My ability to be able to access the banking system, my ability to be able to get bank credit in a convenient way is actually very, very low, and for the most part, bankers do tend to feel comfortable with large corporate clients, nice balance sheets, nicely published printed annual reports, nice cash flow projections, nice, Excel sheets to tell you exactly the way they see their business growing over the next 3 or 5 years. What happens tomorrow or the day after is a different story. But the fact is, the paperwork is very, very nice, and with that, they get the money. On the other hand, there's good entrepreneur. You go to Dharavi in Bombay. I mean, practically every city in the country, all across, you will find lots and lots of micro entrepreneurs whose needs for credit, for example, are quite modest. Maybe 1 lakh of rupees, 2 lakhs, 5 lakhs, 10 lakhs. They don't get it. It's interesting how now the Reserve Bank's draft guidelines for small banks are actually saying specifically that a small bank balance sheet must, in terms of their loan portfolio, 50% of lending to be done of loans up to rupees 25 lakhs, to bring about a certain kind of focus in lending to that category. So really, looking at this as a very large national issue and national problem, and also a part of, I think, the broader theme of financial inclusion. So as a banker, again, over to you, Vishwanathan, you do have to bear the brunt of it.
No, before this conference, I was talking to Mr. Prasad, and I was telling him, obviously everybody will say that the banks didn't do anything in the last 50 years, that is why financial inclusion has become an important, no, not State Bank, all banks put together. Of course, in State Bank in particular, everywhere, it is State Bank in particular. But having said that, jokes apart, see, the real issue is, it is not as if the banks have not gone and lent to all these microfinance and micro enterprises or small enterprises. As a matter of fact, SBI at one time had a huge focus on small scale industries. We had what we call entrepreneur development program. We used to develop entrepreneurs, provide them, equity capital. We had a fund for that. We used to provide equity capital, and then on top of it, finance SME. And we were the biggest financiers, and as a matter of fact, all our guys who are retiring now from State Bank, they're all experts in credit coming out of SME financing. It is actually, you learn credit only in SME financing. You don't learn credit in this project finance or these big corporate credit or anything like that, because, you just take a big balance sheet and write all kinds of things, and, you give marks to the promoter, whether there is marks or not. Because, he's taking up a project of 5,000 crores, out of which 4,900 crores is of the bank and 100 crores is of his. But then it is 5,000 crores, so we don't bother about that. But when a small scale industry comes, that guy can't, it's a completely different paradigm, and that is where the credit analysis, etc. becomes important. The banks learned it, did it. But what has happened over the years is, a bank like SBI is involved in project finance, is involved in this finance, that finance, a new supply chain finance, manufacturing finance. Then you have, agriculture finance, then you have MSME finance, then you have microfinance and all kinds of things, and we don't have enough bandwidth to accord that kind of focus to everything. The new bank license that he was talking about says that as a result of this kind of, broad brush approach that banks are now seeing, doing. You know, they are doing business in the micro segment also, but then adequate amount of focus is not available. So, you know, then comes the specialized companies which are focusing in specific areas, these small banks, local area banks or even cooperative banks. They are all supposed to do this, but then this don't seem to have delivered on all those fronts also. Then we have these RRBs which are all attached to banks. They can also do this work. So having said this, the issue is of focusing, the issue is of providing a commitment to that segment and then innovating on new processes to do it cost effectively. You know, and there again, even an SBI is now looking at, they got huge NPA positions, for example, and NPAs are coming from all over the place. Now we are collaborating with our regional rural banks, we are collaborating with our own BCs, and then allocating clients to those people in that segment, even though they have not lent to them. I mean, it's not been lent through them. We have told them for recovery, we will give you account management job at a price, for example. So they are all closer to the customer and they can go and follow up more effectively with the customer on a day-to-day basis. And one last point, which is needed for micro and small finance, is that you need to go to them on a daily basis and collect whatever they make and then keep it in your account. If you don't do that, then 3 days the money is wasted and lost somewhere else. He will not be able to pay 3 days, a payment on the 4th day. Now I'll give you this example. You know, I used to be in Northeast, and in Manipur, in Imphal, there is a market called the Ima market. Ima is mother actually in Manipuri, and in the Ima market, all the ladies will go buy whatever wares they have to buy in the morning, or they are supplied, so to say. In the evening, everything is cash. And, you know, and cash at a reasonable profit. And they do they are all very, very effective people, those Manipuri ladies who do this business in the Ima market. But what happens, in the evening, the guy who supplied will come and take his money away, and there is a margin which is left with that person. You know, that person's son, who is a drunkard, will come and take that money away in the evening. Whatever is with her as a profit, it goes. If you can have a method by which you can collect that money and put it into a bank account using one of your mobile phones, a kind of collector agency type of thing, it could work. We tried, and I think it is working, but you know, the problem is you don't put enough energy into making this a perfect thing and then activating it and again spreading it out into the world at large in India. We need commitment, we need to push things in that thing, and then you can do it. And that is why the second solution is you have separate companies, let them do this as a profit center concept, and let them make the money. The real issue is one of follow-up, one of understanding the risk properly, one of differentiating various people and giving them, and also building a credit model or a credit rating around those people over a period of time. All this automation can help, and then giving them benefit of interest rates if the credit rating improves. So I would not like to say whether SBI was successful or not successful. Obviously, as a very large bank, looking at a micro, a small, geography or a small business, even a small group of businesses, we may not have been able to do the best, but a best is possible. And here again, like I said in the earlier round, it is collaboration which is going to help, and collaboration, whether it is between SBI and the NBFC and then the further last mile, or SBI directly with the last mile, or how it should be done. Who is going to lend the money? The Kirana store is not going to lend money to anybody. Kirana store is only a payment methodology. It's a human ATM or a institutionalized ATM, for example, without an ATM machine. So that is all they do. But what we need to do is other methods of reaching to the last guy, appraising him, and then somehow ensuring that he pays back. And what is the payment history, what is the payment psychology? Accordingly, we are able to cost effectively position a guy to recover this money. See, these NPAs are a huge problem, and the moment one or two NPAs happen, whether it's because of our own not being we're not following up properly, we'll blame it on the system and say all these MSMEs are bringing NPAs to us. That's the way we talk. I mean, it's an easy way of talking, but I think we need to do this, and it is possible to lend to these people, but the real issue is connectivity, follow-up, and ability to differentiate risk among various people and price our loans differentially and, recover our money. I'm sorry, it's a conceptual answer. I'm not able to, because I know we're not doing it well enough in the banks. But it's not as if they can't do it. They can do it well. Yeah.
No, thanks again. NBFCs, of course, I think have done a great deal of very innovative work with regard to reaching out to this segment of the population. And really in many different kinds of ways, their customer connect tends to be closer, deeper. The NBFC MFIs, for that matter, do actually visit their clients every single week. I mean, that is the business model. So really in the context of the segment we are now talking about, Gagan, what is your experience or your comments?
No, as Mr. Vishwanathan very rightly said, the whole model has achieved whatever success it has achieved on the basis of a model of collaboration between some banks and NBFCs. NBFCs can effectively only be an efficient conduit of credit. We do not have a mechanism where we can collect large pools of capital from the public. It's the banks which have that whole infrastructure in place. But the key point is that NBFCs today, by the nature of their super specialization, by the nature of their focus on select audiences in terms of their customer base, are probably best equipped to handle this. We have to understand the whole success of financial inclusion and also overall credit absorption in the system on the basis of one fact that today in terms of financial institutions, it is perhaps unique to India that the banks are expected to give a 5,000 rupee seed loan and a 5,000 crore project loan. And the whole system has been designed in a manner that almost all flow of credit is to large corporates and to the smallest of borrower is all routed through banks, which is perhaps why in practice banks then tend to crowd towards the corporate space. Individuals tend to suffer over a period of time. And my view is that if that has to be permanently and structurally sorted out, you have to have more and more specialized organizations which have to not be seen as adding to intermediation costs. These specialized organizations have to bring in capital of their own, have to therefore also become risk absorption points for banks. And if all of that is to actually technically happen, then there can be a very beautiful cycle which can be actually created where banks are working with public at large, collecting large pools of capital in the form of CASA or term deposits or whatever, and routing through these select few organizations which are specialized to deliver credit. And probably you will see financial inclusion, flow of credit to MSMEs actually grow in size. I had earlier mentioned that during my limited experience itself, I have seen the whole MSME space from NBFCs, the credit flow having grown almost 5 to 6 times in the last 10 years. I think the potential is to actually grow this 50 to 60 times in the next 10 years. But there have to be structural corrections made, and no longer can we assume that a bank is in a position to do a 5,000 and a 5,000 crore loan.
Absolutely. I think the core point really is that what we need are partnerships, what we need are specialization, and in that sense, what the RBI is doing by way of now looking at a differentiated licensing policy are, I think, pointers in the right direction. I'm afraid we are running out of time. I'm told that lunch is getting served. I will very quickly now do a wrap-up, but before that, just one core theme I do want to have a quick one-sentence kind of response. We are talking of partnerships. Now, one other area which is very critical for financial inclusion, and where I think partnerships are critical again, is financial education or literacy, it is a public good. And one could argue that it's something which the government ought to be doing as a public good. However, we as operators on the ground, all of us in different kinds of ways are doing financial literacy. So just because I said one sentence, how can this public good be furthered through a partnership kind of model?
Well, I really don't know what to say in this, except that partnership will definitely help. You know, the first level financial literacy can be done at the branch level by holding little meetings to tell people what is a bank account and what is what, and what is the advantages, what is the advantages of saving, what is the advantage of planning your expenditure, etc. But beyond that is little more technical, where definitely a collaboration with the other entities will help. Entities which either interact with them very closely on a day-to-day basis, or entities which are specialized, which can pull out people who can be trained to train people down the line.
I think the quick thoughts on this is, one side is all these organizations have a lot of marketing expense to build their business, whether it is NBFC, whether it is a bank and all. How can we say that the marketing expense is for financial literacy? So some portion of that can be very well allocated for financial literacy, and it's about making our asset better. It's nothing to do with like we are spending our money just for getting clients. It's about how to make our assets better. So I think the approach can change from just spending on ad and marketing to financial literacy. That could be one approach. Second is, which I think we have a huge potential, is the new Companies Act stipulated 2% for CSR. Man, tons of money there. I mean, all the banks, all the NBFCs together, we don't need even corporates. Just the banks and NBFC, 2% of the money, can we make it 0.5% of, 1/4 of that mandatory to go for financial literacy? Because this is going to change the landscape of the country. Why not mandating it that whatever out of the 100 rupees they spend, 25 definitely goes for financial literacy? That's going to change the entire landscape of financial inclusion.
Yeah, there was a thought which came from my team that, a lot of the money that we spend towards, so to say, business development and advertising actually be spent towards getting people trained within the organization to then train others. We run a very interesting program for a pharma company, in which to the pharma company employees, we are teaching them on how to actually evaluate people. This pharma company gives out free cancer drugs to people who they believe are not capable of paying. So if a lot of organizations like ours actually start adding up to their training budget specifically for initiatives like this, even at the cost of reducing business development expenses, I think we would actually see functional movement in this whole literacy drive. And this would also require us to involve unique stakeholders, like in our case we are involving a pharma company. I believe there are tens of such opportunities out there.
Yeah, I think, a CSR, spend on financial literacy is certainly a good idea. What I believe is, and which was also stated in one of the earlier sessions, that one has to have a much more holistic approach to financial literacy. It must start right from the school days, and also, to the fact that even when we are thinking of making financial inclusion last mile coverage, the faith of the person in a currency note and the faith of a person in a digital number that he owns so much of money are two different things. Now, how can you breach that so that his confidence in that digital number is as much as his faith is in a rupee, is something which is very, very critical. And I guess financial literacy has to cover all of these, so it must start right from the school textbooks up to the CSR spend on financial literacy.
Thank you very much. So I think the answer is simple. Constructive partnerships are not just command and control. Recognizing the huge diversity of the country and therefore allowing different kinds of models to work and to flourish and to flower is really the way forward. And yes, I guess we are at an inflection point. The future is looking very, very exciting, very bright, and I think we all have good reason to be very, very hopeful. With that, I'll close. Maybe just a question, one or two, and we just have to... Yep.
Well, we have time for a couple of questions, if any. We'll pass on the mics in the audience. You're most welcome to ask a question.
Good afternoon, panelists. I'm Prateek from PNB Investment Services. My question is, with a view of financial inclusion, do you think that microfinance needs more encouragement and supports from banks in regard to the large corporate lending? I wonder how many micro borrowers could have been accommodated from the pie of a handful of large corporate defaulters who have been buying cricket teams, buying aircrafts, even after defaulting. Do you think that microfinance need more encouragement rather than the pie of the large corporate lending?
Okay, thanks. I will spare my friend Vishwanathan on this one and respond directly. The short answer is every segment of the economy needs credit. We are a credit scarce, a capital scarce economy. There will always be competing demands for capital, and therefore to that extent we just have to live with a certain reality. Having said that, yes, of course, the fact is that if the banks were being able to give more credit as microfinance, directly or indirectly, that is very, very good news. Again, the happy news is that, just to share with you, fiscal end of 31st March 2014, bank credit to NBFC MFIs grew by 48% over the previous year. So much good work is going on. One last question. Okay, then I guess in that event we will close now. Thank you very much. Thanks a lot. Thank you. And thank you, everybody.
Thank you.
Thank you so very much, Mr. Prasad. And of course, microcredit and microfinance, the panelists made this a very interactive session indeed. And in case any of you would like to take the question and answer session forward, you're most welcome to do so during the lunch hour, where we encourage all of you to network and know each other. But as I thank our moderator, may I also request you to please present with a token of our appreciation to each one of our panelists. Let's put our hands together, ladies and gentlemen. Mr. Prasad, thanking each one of our panelists with a token of appreciation and remembrance. Thank you, sir. May I also take this opportunity to invite on stage Vineet and thank our moderator for joining us for the session and making it so very engaging with the counter questions and more. Once again, Mr. Prasad, we truly appreciate your presence and we'd like to thank you.